The following is a presentation of TFNN. It is now time for Trade What You See with your host, Larry Pesavento. Now, Larry Pesavento.
Good morning, Vietnam. Well, and welcome back, I guess, to myself. It's been a long time, been a month. I've had a very relaxing month, very, very enjoyable. But I miss the markets, and I miss all you folks, too. So we'll start the show today with what I think is one of the most amazing charts I've seen in many, many years, and that's the Dow Jones Transportation as it compares to the Dow Jones Industrials. And if you'll take a look at this, you can see that the divergence is really quite startling. Now, the correlation ordinarily between the Dow Jones Industrial Average and the Dow Jones Transportation runs about 90 to 95%. That's tremendous. And as you can see now, the correlation is less than 5%. Later on, after I talk a little bit about the transportations, I'm going to, put a long-term chart on this just to show you that when these divergences happen, that it's very, very important, and you have to pay incredible attention to it. So the transportation index is made up of the stocks that move the goods that have been sold, whether it's Apple iPhones that are made in China or whether it's cotton shirts that are made in India. They have to come here. They have to be moved to the market. They have to be put in stores so people can actually buy them. This affects the prices of stocks like FedEx and also UPS and the railroad companies and people and the ship and trucking companies. And if you'll look at these stocks of these companies, they're absolutely getting decimated. I mean, they're really getting hammered really bad. Now, if the economy was really good, like they're trying to tell us, wouldn't these stocks be moving up because business was good and that they actually were making some increase in earnings and things like that, as opposed to what they're doing is they're buying less of the large trucks than in a long time. Large truck sales are down quite a bit. We've talked about that before. And so this is something that I think you've got to really pay attention to right here. Now, I know I get accused of being a perennial bear, but, I was bearish on August the 3rd. I gave up the ghost on August the 12th. And, I went back in again last week, and I'm still in it. And I really believe that we're getting ready for some real serious moves to the downside, not just because of this index that I'm watching here as the divergence. It's the fact that all of the patterns that we've looked at have been, fulfilled, these ABCD patterns. And we'll cover some of those as we go through the show. But I want to right now talk a little bit about Richard Russell. Richard Russell is the man who brought Dow theory to its prominence. He's 90 years old, still going strong. And, he is as startled about this as I am. I spoke with Arch Crawford last Thursday because I had seen, the divergence. I wasn't really following the transportation. Someone brought it to my attention, and so I immediately called Arch. And he said he had been speaking with Richard Russell about it, and Richard said that this was like, the kiss of death. I don't know what that means, but that's what he said. So, the transportation is almost breaking under the June and July lows, which is, really amazing. The Dow would be down around 11,500 if that were happening. So, whether this is a trap or not, I don't know. I remember reading a book once called My Own Story by Bernard Baruch. He was one of the most powerful people in the financial community during the 20s and 30s, incredibly successful. He was a very close friend of J.P. Morgan as well as Jesse Livermore and others. But he said that in his book, he said one of the greatest mystifying scams that happens on Wall Street is that people will inflate something to a very high price, and that entices people to buy it all the way down. And, we saw that in 2000, and it's probably going to happen with Apple, too. I know it's the greatest product in the world, and there's nothing like it, but, this can happen. We've seen it happen before, over and over and again. And the pattern in Apple, I'll post it a little bit later, has been, decidedly completed. It actually completed around 680. It recompleted again at 700 when it made the 1.27 expansion. But let's get back to the transportations. If you'll take a minute and study the transportation chart, the long-term chart that's in there from 2007 through where we are right now, if you go to the period when the market was making new highs back in 2008, you can see that in October of that year, the Dow Jones was making a high in that August area, and then the transportations made a slightly higher high in October, and the market made a much lower high after that in the Dow Jones Industrial Index. Well, at that time, the correlation was running, incredibly well. I mean, the market went down, the transportation went down. When the market went up, the transportations went up. This is not happening now, folks. What you're seeing here is an aberration that hasn't happened in recorded technical analysis that we can find. And this is truly an amazing correlation that has just disappeared. Now, I hear the theory all the time about the Federal Reserve is always in there, and they're the ones that are manipulating the market with their plunge protection team, and all those things. But, frankly, I don't believe any of that. If they were going to manipulate the market or some way, why wouldn't they manipulate the transportations? It can be manipulated if anything else can be, and I don't believe any of them can be manipulated for a very long period of time. I believe we're in free markets. These are just normal markets. They're having the same patterns that we see all the time, A, B, C, Ds, Gartley's, butterflies. They go down and they test the moving averages that Basil talks about all the time, incredibly well. So they're no different than where they were in 1920, 30, 40, 50, 60, 70, 80, or 90. Or 2000. They're all pretty much the same. So this is what I'm seeing. This is something very ominous that's going on right here, and I think we have to pay very, very close attention to it, because it is very, very important on a long-term basis. Now, the utility index has been under a great deal of trouble also, and it has still been going down. And we had a little bit of a rally, a very, very small ABCD pattern in the utilities in the last few weeks, where the market ran up and just stopped right there. It didn't even make a 38.2% retracement off the August highs. But the utility index looks a little bit better, than the Dow Jones does. Dow Jones Utilities, of course, but that's the Dow Jones Utilities looks a little better than the Dow Jones Transportation. That's what I was trying to say. So we need to watch, if the utilities, if I'm wrong, if I'm totally wrong, and, we're looking at a big bull market in the stock market, and what we had has not been a big bull market. It's been a, 6 or 7% move in the last couple of months, and it's up 15% for the year, which isn't bad, but it's not like, the big bull runs that we had coming off the 2009 bottom and the 2003 bottom. So this is what I'm expecting to have happen, is that we are getting ready for something really major to the downside. Now, if we close higher than we did above, I believe it was 13,700 in the Dow and above 1,485 in the S&P 500, then I would say that this has had either a false breakout to the upside, or we are going to be heading down. So those are the things that I'm following, really, really closely. I mentioned at the beginning of the show about the ABCD patterns that are completing, and as many of you know, I use the New York Stock Exchange Index as my, way of looking at the market, and I posted into the Tiger TV the New York Stock Exchange Index going back to last March. We did take those highs out, which completed a butterfly pattern up at this 84.60 level that we hit last week. And it was completed two perfect ABCDs going back to that June 4th low where we had the lunar eclipse and full moon. So this is why I think one of the reasons. We've had all of these others have the same patterns, except that the Nasdaq has gone up a little bit more, and that's mainly because of a couple of stocks. One of which, of course, is Apple, and this is an amazing stock, folks. In some day in history, I don't know if it'll be when I'm still alive or not, but people will go back and look at this and look at it as mass pandemonium. Because when I see people on the financial press showing the Apple Store, and the people are standing in line for $500 to buy one for somebody else, they're getting paid $500 to, stand in line to buy one for somebody else. I mean, this is just like the tulip bulb mania of, the 16th century Netherlands, where a little tulip bulb went to $25,000, and a few years later it was selling for $2. So I'm not saying that's going to happen. Apple, I'm just saying that the way that things happen in the market unfolds by fear and greed, and this is what we're seeing now. We're seeing massive hysteria is what we're seeing in the stock itself. So we'll have to see what history says about it in the longer term. But this is what we're looking at. If you have any questions, we're looking at 800. I have to look it up. Can you believe this? 800-927-6648. That's a really bad sign when you can't remember the phone number. I'll have to write it down. I really had a enjoyable month off. I mean, I traded every day with the family and everything, which was fun. But frankly, it was really, really great. If you have a question, it's 877-927-6648. That's the number that we want to be calling if you do have a question. The VIX index has held up above the August bottoms, which is what we were looking for. And I was hoping that that's a very bad trading word, hoping. That's not very good. But it has made a double bottom down here on that September 17th level. And if we have if this market starts to move up, we could have a really, really big move off of this. So I'm really following the VIX index very, very closely because it's very complacent out there, folks. And when it's complacent, that's when things bad usually happen. So that's the thing that I keep focusing on. Now, talk just a little bit about trading before the break. I mean, a lot of people like to trade the E-mini S&P and the NASDAQ and the Dow Jones. Yeah, those things, they're okay, but, they're beginning to look like melted butter. I mean, they're not doing much at all as far as the trading. If you want to trade something that's fun to trade, trade the crude oil and the gold and the euro and the British pound and the Australian dollar and the dollar index. Those move a lot more. They give they give you a great deal of volatility, and they're 24-hour markets, most of them, and so they give you plenty of things to look at. So keep your eyes on things just other than the stock indices. You should watch everything, of course, but for day trading and stuff like that, I think the best thing to look at is the way you trade the euro and the pound and the Australian dollar, the Japanese yen. I mean, all of these are such great trading vehicles, and especially gold, which we'll get into a little bit later, because we're at a very, very critical spot in both gold and the silver. Now, but right before we get to the break here, I want to cover one more of the markets. That's the Russell Small Cap. And, didn't quite make it. We've got a break here. We've got to pay a few bills. It's 800-927-6648 if you have any questions.
In just December of last year, the price of gold was down over 10%. In today's highly volatile gold market, you need someone in your corner that understands the complex relationships that exist within the price of gold, as well as within a variety of gold equities. Whether it's the South African gold miners and knowing how the rand-dollar relationship will affect their bottom line, or understanding how John Paulson's $5 billion trade in the GLD can move the market, Tom O'Brien gives you the direction you need to become a better trader each week in his newsletter, The Gold Report. With over 20 individual equities covered and almost another 20 on the potential watch list each week, in addition to covering the XAU, HUI, GLD, and dollar, The Gold Report is a great source for any trader that is looking to be diversified in today's volatile gold market. For your 30-day free trial to Tom O'Brien's Gold Report, log on to TFNN.com today. Don't miss out on this great offer. Act now. You take a hands-on approach to managing your investment strategy. You're always looking for the next trading opportunity to magnify your perspective. Direction Shares connects sophisticated traders with a powerful array of ETFs from a wide range of asset classes. The markets may go up and down, and you want tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foreside Fund Services, LLC.
80% of traders fail because they don't know when to get in or out of a market, and all because no one taught them how to read the signs. You see, the stock market has a universal language called Japanese candlesticks, and each day, the buyers and sellers, the bulls and bears, go to work and build signs. This language has been around for thousands of years, and it's easy to learn. I'm Steve Rhodes, co-host of the Money Masters Show, and I'm a master sign builder. Download my free report, Candlesticks, The Speed of Trust, on the homepage of TFNN.com for one of the best-kept candlestick secrets. I'll also be conducting an online course Friday, October 19th, to teach you the language of the market's sign builders. You'll learn the best entry and exit techniques and strategies that will create extraordinary rewards. The course will be archived so you can review it as many times as you like, because trading or investing without learning this language is like running a red light. It's an accident waiting to happen, and there's no airbags or seatbelts. All the details are on the homepage of TFNN.com.
Kate Stalter's exciting newsletter, Low Priced Leaders, has just launched, and now is a great time to get a 2-week free trial. Every Wednesday afternoon, Kate sends out her weekly newsletter to her subscribers, where she focuses on small cap stocks with market caps under $2 billion, as well as low-priced equities with share prices ranging from $5 to $12. Kate tracks a variety of stocks with a combination of strong technical support and solid fundamentals. Many of the stocks featured will be recent IPOs. These newer issues are often some of the biggest price gainers in the market and provide an excellent opportunity for substantial gains if timed correctly. You can catch Kate Stalter live on Tiger TV with her Small Cap Roundup every Tuesday and Thursday at 11 a.m. Eastern Time, and visit TFNN.com right now to get your 2-week free trial to her brand new newsletter, Low Priced Leaders, while locking in the low introductory monthly rate of only $37.50 per month, almost a 50% discount. Act now.
This segment is brought to you by Great Panther Silver. For more information, just click the Great Panther Silver banner on the front page of TFNN.com.
Okay, we're back, folks, and I have posted a chart of the NASDAQ daily that shows the long-term butterfly pattern that's in there. It also shows the double top that I was expecting, back in August, and once we went above that on that, really big day when the Fed came in, that basically reneged that pattern. But we've completed now a 3-drive pattern in the NASDAQ. And if you look at the chart of Apple, which I'll post later, you'll see that these charts look almost identical. I mean, the NASDAQ is pretty much Apple, it looks like. Their correlation is, probably 97%. But that's what we're looking at. And as you know, when you travel, you always have things go bad. And when I got back, I got some really bad news. Believe it or not, while I was gone, Merle Haggard was here giving a concert here in Tucson while I was gone. And I'm a big Merle Haggard fan. And it was very sad. It was the worst thing that happened to me in the whole month was missing Merle Haggard. I actually sat next to him on an airplane once when he was going to a funeral in Japan. One of the few times I ever flown business class, and he was next to me. And it was really, I talked to him for just a few minutes because it was a red-eye flight, but it was very enjoyable. Big fan of Okie from Muskogee. Okay, we know that the NASDAQ has completed the pattern, and I'll show Apple a little bit later. Also on the news front, I would just want to tell you how wonderful Wall Street is. I have a good friend who works for one of the major Wall Street firms for 40 years. He's one of their chief technical analysis. He was the chief technical analysis. 2 weeks ago, last Friday at 9 o'clock in the morning, his boss came in and said, you have 2 hours to clear out your desk. We no longer need you. That was after 40 years of service. He started with him when he was 24, and he's 64 now. They let him go after 40 years. He was very, very good. You don't stay in that business for 40 years if you're not very, very good. He said, look, can I at least have till the end of the day because I've been here for so long? He said, okay, you can have till the end of the day. At 12 o'clock, the boss came back with 2 security guards and told him that he had to leave now. And he had about 15 minutes to collect his, little trophies and, memorabilia that they have, on your desk that you have. And that was it. After 40 years, and it's really a wonderful, wonderful thing. But that's the way it happens to be on Wall Street. But that's one of the really good things about working for yourself and having the total freedom of trading is that you don't have to work for anybody. And that's the one thing that I look at. I keep telling my kids I'm going to retire, and they always say to me, "And do what, Dad?" Because this is what I really like to do. And when I had this time off, I realized how much I really enjoyed just focusing, on the short-term trading and just enjoying the trading. So that's when I'm not going to mention which firm it was, but the initials of it start with one letter, and it's not A or B. So that's the only hint that I can give you. He actually started to work with Shearson Lehman, back when I was at Drexel, back in the early 70s. And of course, they merged with, it wasn't Goldman Sachs. I said A or B, and it's not D. So I wonder what it could be. Maybe it could be Citicorp. And that's who it was, folks. I have, what am I going to do? They're going to fire me? Who knows? Okay, that's we'll get back to business here. We've got a lot to cover, and we only have a short period of time to cover it. I want to cover some more of these ABCDs that have completed. We had the ABCD complete in the S&P 500, which is also it's completed in the Dow Jones and all the other things that you're looking at. And so we have a lot of things occurring here that tells us that we are, very, very close to a what I think is a pretty significant top in the market. And so keep an eye on that VIX because I think it's a real beauty here if it's going to work like I think that it might. But we'll have to, just give it a little bit more time to see if it will give us this extra push to the downside. And when it comes, it's going to be pretty dramatic. And that's the thing that we need to focus on the bonds too because we'll cover the bonds and the notes when we come back from the break. But I also want to cover what's happening in China because something really significant is happening there, folks. It's it's getting a little bit of press, but not nearly as much as you might think. And I'm going to put the chart in here that I talked about several weeks ago. And you'll see that the relationship between the Shanghai Index and the S&P 500, that has the same type of negative correlation that we've had with the Treasury, with the Dow Jones Transportations versus the Dow Jones Industrials. We'll cover this when we get back. 1-800-927-6648. And please, don't everybody call in at once. The board is lighting up too much.
You've heard Tom O'Brien on the air, and you've seen him on Tiger TV as well as being featured as a regular CNBC guest and contributor, and now you can have access to his expert trading advice each morning through his daily trading newsletter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, gives traders, investors, and money managers a thorough strategy for trading stocks, options, and indices every market day. Market Insights comes out each market day before 9:30 a.m. and provides traders with Tom's daily commentary, opinion, and specific trade recommendations on the markets. Using advanced Fibonacci methods, volume indicators, Gartley patterns, candlestick charting, gaps, and market timing, Market Insights will give you specific trade recommendations including entry, stop, and exit prices. The summer is over and traders are back. Get your 2-week free trial to Market Insights today by visiting the front page of TFNN.com. Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Recently, Basil Chapman has had some outstanding trades in his newsletter, The Opening Call. Each morning by 9 a.m., Basil uploads his newsletter to the TFNN servers so that his subscribers can access his expert trading advice. Basil gives his take on the direction of key indices and updates any active trades that his subscribers are currently in. Just recently, Basil's subscribers closed out a short position in Chipotle Mexican Grill, CMG, for more than an $86 profit per share, over a 20% gain in just one position. If you'd like to check out Basil Chapman's newsletter, The Opening Call, then visit the front page of TFNN.com and click Trading Newsletters. There you'll find Basil's newsletter, The Opening Call, where you can request a free sample copy. Also, don't miss Basil's program, The Tiger Technicians Hour, Monday, Wednesday, and Friday, 11 a.m. Eastern, on TFNN.
In just December of last year, the price of gold was down over 10%. In today's highly volatile gold market, you need someone in your corner that understands the complex relationships that exist within the price of gold, as well as within a variety of gold equities. Whether it's the South African gold miners and knowing how the Rand-dollar relationship will affect their bottom line, or understanding how John Paulson's $5 billion trade in the GLD can move the market, Tom O'Brien gives you the direction you need to become a better trader each week in his newsletter, The Gold Report. With over 20 individual equities covered and almost another 20 on the potential watch list each week, in addition to covering the XAU, HUI, GLD, and dollar, The Gold Report is a great source for any trader that is looking to be diversified in today's volatile gold market. For your 30-day free trial to Tom O'Brien's Gold Report, log on to TFNN.com today. Don't miss out on this great offer. Act now.
This segment is brought to you by Crocodile Gold. For more information, just click the Crocodile Gold banner on the front page of TFNN.com.
Okay, we're back, folks, and we were talking about the discrepancy between the Shanghai market and also the S&P 500. Now, folks, you realize that the Shanghai index doesn't have the volume or the liquidity like we have in our markets, because China is just moving from communism or socialism to free capitalism in a very slow amount of time. Now, last year in April, I was there giving a speech for the for the Shanghai stock market. And they have a brand new building there. It's 94 stories high. It's really a spectacular place. And the market was at 2,500, making a double top at a 786 retracement of the previous monthly highs. And it was just so bearish that you just couldn't believe it. And everybody in the room was incredibly bullish at this 2,600 in the Shanghai index. I believe it was 2,550, as I recall. And yet it started down just a couple of days later, and it was really, it's been down. And the bad part about this chart is what you don't see, is that after this bottom that was formed in the chart that I posted in the Tiger TV, we had a very strong rally of about 6 or 7% in 3 days. And then in the next few days, the market totally gave everything back and collapsed below the low and accelerated after it went down below the low. So that's a really bad failure at a 786 level than the Shanghai index. So that has really bad ramifications. I don't know if it's all of China, because you can't say that because that's just Shanghai, and but Shanghai is basically the Chicago of China. Beijing is the New York, and Shanghai would be the Chicago of because they have silver futures and some other things too. But that's what I'm looking at on the charts. But it is rather thin compared to the rest of the markets in the world. It's a mere fraction of what happens, with the euro and some of the other things that we look at. Okay, we want to talk about the bonds now. And I think we'll start out with the notes because those are the shorter-term paper. We talked about this head and shoulders pattern. Right before I left on vacation, we were making that right shoulder up there at the 61% retracement in the notes, exactly at that 134 level. That was equivalent to the 151 level in the Treasury bonds. And so that has also, told us that we are, this pattern has completed, and it gives us a profit objective, a lot lower. And this is telling us that this market, if this head and shoulders pattern is for real, is in a bear market now because we've made lower highs. And the question we're going to have now is how much are we going to rally here to see if we can make one more retracement before we come down, one more time. So we have to, watch these very closely because if we get a rally back to that, 150 level in the Treasury bonds, I would think that this would be a really good place, to take a picture of where we think where we should be anyway. That's just the way I'm looking at the longer term Treasury bond. You'll be able to see here that if we do get up to that 150 level, that would be the 786, and it would equal the last rally that we had, which happened to be about 7 points. So if we get a 7-point rally off the bottom at 144 up into that 150, 151 level, I would think that it would be a really good place to look at the short side of the Treasury bond. This is a debt cycle that is finished. I really believe that it's been that cycle that we looked at from 1981, to 2011, and it's really amazing. Basically what's happened, folks, with interest rates this low, people with a great deal of money, millionaires and billionaires and stuff, they really can't put their money in interest-bearing accounts because they're only making 0.5% to 1%, on a even less than that on a CD. But in the Treasury bonds themselves, 30-year bonds, 2.8%. And then with inflation at that much, they're not even breaking even. And so this is a real fundamental factor that's occurred. It's related to the trillions of dollars that the government has spent over the last few years trying to support the economy. Okay, we got a caller. Yay! Let's give a round of applause for Danny in Atlanta. Danny, are you there?
I'm here. You're the one that deserves a round of applause, Larry. We really missed you.
Yeah, I know.
Hey, I posted. No, we really did.
Okay.
I posted a chart of silver daily in the den. I don't know if you can see it.
Yes, I can.
Okay. My question is, we're at three different ratios from the all-time high, and from 44.22, and then from the most recent high at 37.60. Is the two ratios to the right, are they significant since we're below the most recent high, or are they negated until they get above that most recent high?
I think I still think they're viable there, Danny. I really do. They're at the ratios. The one I'm watching, of course, is that major 786 off of the one from February. Now gold went up and matched that high by just a little bit, which also happened to be the 61% retracement, of the whole move. And gold is a much larger market than the silver is. So I'm going to put in the Tiger TV the gold chart, and you'll see if you go back to the all-time high in gold, that gold-silver index, you'll see that it's also made the 61% retracement. But the way you've got your chart done, Danny, is perfect. You couldn't have done it any better, if you'd have been taught by, Mr. Gartley himself, because that's got everything in there that you're looking at. We're at a major point in the gold and silver. We've had a tremendous move since those multiple bottoms that we looked at, weeks and weeks ago when nobody was really wanting to buy gold and silver. We kept talking about it that, these are making higher bottoms, folks. You have to pay attention to this. And each one of them was a 618 or 786. And now we've had the explosion to the upside with a little bit of increase in open interest and stuff, but not much. So what we want to watch now is to see what kind of a correction we get from this level. The last corrections that we've had have been only 3 or 4 days, and were very minimal. And if that happens and the market keeps going back up, look out, because gold's going to take out $2,000 like it didn't even exist, in my opinion, because this market exploded off of that bottom, which was a 61% retracement on the weekly, and that was down at 1522. And, now we're, 12-15% higher than that now. So this thing could really go if it doesn't back off much from this level.
Okay, if you have time, can you look at the XAU or HUI?
I have the XAU. I'll post it into the den again, and you'll be able to take a look at it. And I also am going to put the gold chart in. I thought that I had done that, but evidently I didn't. And I wanted to do one other one besides that, if I can find them. I'm trying to do so many things at once, and hopefully I'll get the gold one here. Unfortunately, I didn't put the gold one in. I don't know where it is. The one I want to cover, though, that I think is important is the copper chart, because you'll see this divergence that we'd had in the S&P versus the copper. Copper has not just actually the high that it made last week at $3.84 a pound was exactly 786 coming off the February high. And you'll notice that the S&P 500 went into new high ground. And so, you have another divergence there also. And here again, the copper runs about 90%, correlation with the stock market. But if it hadn't been for the Fed, I don't think copper ever would have made that last 30 cents, because it just literally, exploded out of there in 5 or 6 days, which was probably shorts finally giving up.
Yes. So are you back full-time now? Are you going to be doing all 3 shows, or are you going to cut back a little?
Those are multiple choice questions. Actually, what I'm going to do is, I had so much fun. That's really the first time in a really long time that I literally didn't have a schedule. I still worked every day. I answered my emails, and I came on TFNN once, but I actually was really enjoying it. We were there with a gracious host, and we had just an incredible month, and we really enjoyed it very, very much. And so I'm just going to play it by ear. I love doing these shows. I love my teaching that I do. Fortunately, not many people, want to be taught anymore. They want to learn it themselves, which is good, because that's that's a good way to learn it. But I am in the hedge fund, and I do work for the hedge fund every day, the 3 of us, and we've been doing very well there. So, but I enjoyed the trading a lot. Even though I had doctor's orders, I couldn't work more than 4 hours a day. I didn't work more than 4 hours a day, but I spent most of that time trading. So it was a lot of fun.
Okay.
I'm not a spring chicken anymore, and it really makes it a lot of fun when you're trying to do it at 72.
Well, we're glad you're back, and if you have to cut back to once or twice a week, that'd be better than missing you altogether.
Oh well, I don't think I'll be cutting back much. I really enjoy it. First of all, I have to get prepared to doing it. You have to get. This one it was rather easy to prepare for, but each day, I try to, each time I do a show is to try to pick things that are relevant in the market, and frankly, we're at such a powerful point in these markets. The fact is, as a matter of fact, I'm just going to show you the gold, what's happened to it, because we had a last week when we made that high at 1790, we were completing a big ABCD, on the 60-minute chart that made a beautiful 3-drive pattern, and that's why we were expecting a correction. Now, if we can get below 1750 in this move, that would mean 1710 would be the next spot that we'd be looking at in the gold. That would be equivalent to about I think $33 an ounce in the silver. So we'll watch those as we go through. But this market still looks bullish, and boy, any close above 1,800 in gold, boy, it's going to tell you that the dollar is probably going to be under a great deal of pressure. That don't mean the euro is going to go up. It just means the dollar is going to be under pressure. So, we'll have to wait and see. Maybe there'll be another divergence there. Who knows?
Thank you, Larry. We're glad you're back.
Okay, Danny. Yeah, thanks for calling in. I really appreciate the questions, folks, because it makes me realize, what you're thinking of at the time as you're looking at the charts as I'm looking at them, and that always makes, a lot of good sense. So we know that the market in the gold has completed some pretty good patterns up here at the 786 level, and long-term 618. That's off the highs that we made, way back in. I think it was August of last year in gold, whichever it was. I'm not sure. Let me see if I can quickly pull up a chart here on the daily. It might need. Oh my gosh! I can't believe I won't be able to do this because it needs refreshing so bad that it would take too long to do the chart. I believe. Yes. Well, it would be way back. I will show you this. This is the last chart that I had from when we were talking, folks, and. Some of these bottoms are going to be not set right, but you'll see the 5 higher bottoms. Well, I'll just put them in here one at a time, so you'll see them all at once, and then you'll know that what's what we were looking at. And this was what we were talking about, why we were so bullish, on gold, way back in late August. The fact that it took off above that 1630 level. And immediately ran $100 an ounce. And now we're at the 618 of the long-term move going back from last August at 1932. And it was a very, very modest correction, folks, that took, basically 7 months to complete in gold. And it didn't back off very, very much. So believe me, the technical part of gold, in other words, the number of buyers and sellers that occurred between October and June was substantial. So believe me, if gold starts to move, it can go a long, long way. It has a technical base, to actually do it. What we're watching for now is we're watching for these little corrections that we've had along the way. We've had a 5-day correction that occurred in late August. We had a 3-day correction that occurred in September, which was virtually nothing. And now, we're in the midst of a little bit of consolidation up here right at the 618. So I'm expecting a little bit more of a correction in the gold. Now, the ideal situation is if you're bullish, and that is if the gold corrects, it will not correct any lower than around $16.90 an ounce. That's about $75 from where we are now. And it will be a 382 retracement. And the ideal it would take about 8 or 9 days to make that, and preferably in an AB equals CD format. That would give you a really good chance, to buy the gold if you missed that, big part of the move. And that's what I see is if we can get 1690 in the gold. I'm not saying it's going to get there. I'm just saying the correction that probably started last Friday, that big ABCD, is going to go between 1710 and 1685. So we just want to watch how long it takes, to do it. These markets are not very hard to figure out if you watch the volume of the buyer, not the volume. Well, it is the volume, but also watch the length of the bars. In other words, if you have a lot of power and thrust that Tom always talks about with his volume, that's telling you that players are either leaving or coming into the market in mass, and that's where you want to be. You want to be where the action is. And so what we're waiting for now is to see if this action unfolds like we think. Okay, we're going to get back and wind it up. 877-927-6648.
If you're an investor looking for a great weekly investment newsletter, then now is the perfect time to try out Ken Shreve's Ultimate Growth Stocks. Every Tuesday, Ken breaks down multiple sectors in his weekly newsletter, Ultimate Growth Stocks, with a full in-depth report including specific trading recommendations within his model portfolio, charts, sector analysis, upcoming economic data, along with intra-week trading updates on newsletter positions whenever the market dictates. Right now, you can receive a full month, that's 30 days, to evaluate Ken's newsletter free of charge to see if it fits your trading plan. At less than $75 per month, Ken provides you with his expert trading advice that can pay for itself in no time. Take advantage of this great offer by signing up for a 30-day free trial to Ken Shreve's Ultimate Growth Stocks today. Don't let this offer pass you by. Visit the front page of TFNN.com and sign up now.
With the launch of Tiger TV, TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, Ken Shreve, Kay Stalter, David White, Larry Pesavento, Victor Jones, or Terrell Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen, live during those shows, and have access to all those charts. You can test drive the Tiger's Den, absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's new trading newsletter, Patterns, Profits, and Peace of Mind. In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the forex market, and more. And you'll get the Technical Corner segment, which is a short but powerful weekly training session on trading. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you just the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 weeks. Go to TFNN.com and click on the free trial link at the top of the page. That's an $85 value, yours free when you register right now. Get Larry's Patterns, Profits, and Peace of Mind and get the edge you've been looking for.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Okay, boys and girls, we're back into the home stretch, and down the stretch they come. Okay, I posted the chart of Apple. As you can see, it looks almost exactly like the NASDAQ itself. It's completed a 3-drive to a top pattern. It's completed the expansion numbers. We certainly have some bullish news on Apple. I mean, if you look at the TV programs, you can see the mobs that they have in all the stores across the country. It's really quite amazing. And this is all the news is out. I mean, they know they've sold everyone in India has an iPhone 5, and everyone in China has an iPhone 5. As a matter of fact, I'm the only person that doesn't have one, and I'm really thinking about buying it. Well, the thought just passed, so I guess I won't be buying it. So I want to finish the program with a very important chart. After I spoke to Arch Crawford, who had just spoken to Richard Russell, I took an idea that Arch had given me about, the transportations might be a better indicator of what's happening with the economy. And so what I did was I overlaid the transportation index over the Bradley stock market model. And if you have a chance to take a look at it in the Tiger TV, you'll see that the correlation is incredibly high, well over 80%. and it is really following along, and it looks like we're going to be heading into the early part of 2013 on the transportations to the downside. But this divergence that we had in the transportations, folks, this is historical. I mean, we've never had anything like this before. Richard Russell, who's 20 years older than me, almost 20 years older than me, has never seen it before, and I certainly haven't. And, of course, Joe Granville also has reported on it, too. But, people just at times like this, they don't really, say, what does this really mean? Well, you've got to go a little bit deeper and, try to, understand what's happening, because this is where the charts will help you along. Because if the market was really bullish, people would be buying these transportation stocks because they would be moving more goods, and they're not moving more goods. We've seen that in the that Baltic Dry Index that I've reported about. We've seen it in the usage of electricity across China. One of the things that we looked at, and we looked at the amount of garbage that's being moved. The garbage index. They even have one of those. I can't believe that, but they do, and that shows that there's less garbage out there. That means people are not, using as much. But maybe I'm wrong. I could be, and I often am. But anyway, pay attention to this divergence. I think this is the most important divergence that I've seen. As a matter of fact, I don't follow the Transportations Act closely. About every week I look at it. And when I looked at it last Thursday, I was shocked at, where it was. And I immediately called Arch and asked him, what was going on. And he had just spoken to Richard Russell. And that's where I came up with the idea of, putting the Bradley model over the transportation. And it looks like, and I know it looks like I'm trying to, build a case from my own position, but this is what I see. This divergence is not like anything we've seen before, and so hey, listen, even a paranoid person is right once. You have to remember that. It's a very important part of Freud's psychology, and I don't think I'm paranoid yet, but I guess I'm getting closer and closer to that. The last chart I wanted to talk about was the euro. If I can get it to pop up here. Oh, one other one's really important here. We've got one that's very, very important that's holding right now. This is crude oil, folks. If we get crude oil going below, $90 a barrel, we got big problems in crude oil. And I don't, but people have big problems being bullish in crude oil if we go below $90 a barrel on a closing basis, because this market has had a really significant correction in 5 days. To the tune of about 8%, and if we don't hold $90 a barrel level, the next level is about $8 a barrel under that. Well, that's it, folks. First show went okay. I still got my job. Everybody have a wonderful day, and may God bless.